All right, we are keeping our eyes on the markets right now. A little bit of a mixed picture here. Joining us for more from Chicago is the co-founder and chief market strategist at Path Trading Partners, Bob Iaccino. Bob, good to see you. Thank you very much for joining us.
Good to be here.
What's it been like? Let me just ask and start with this. What's it been like over the past week or so for you?
Well, it's kind of a two-sided story for me. We went to cash pretty early last week. It was a gradual process, and it was not any sort of swami moment for us. We just had price action that triggered us getting out of trades we'd held for quite a while. We made decent money on them, so it wasn't any sort of a stressful week at all. So from my perspective, it was kind of, I don't want to say good, because I don't want to say that when people's portfolios are being hurt, but I love that we're going into earnings season with this much of an equity market discount. Doesn't mean it'll work, but certainly you had to outperform on a massive level to continue to shoot up to new highs with record earnings that are the same as the last quarter's record earnings, with record revenues that aren't much changed from last quarter's record revenues, and with the headwinds of trade tariffs and the like coming down the pipe. So it's been pretty calming here. Having said that, we've seen a lot of the opposite.
Meaning what?
Meaning there's been a lot of stress. And one of the things I continue to tell both clients and just people that I bump into and talk to and other people in the industry is that these things are always painful when they're fast and when they're, I don't want to say unexpected, because I think this should have been expected, but it's the speed of it that bothers people. It's not the 8% in the NASDAQ. It's not the 7.2% in the S&P. It's the speed of it. And we always recover when things balance out in terms of the markets themselves. It's just a matter of how long it takes.
Well, what are you seeing right now? You know, in looking at the markets, definitely a choppy session. Volumes are a little bit lower versus where they have been. It still seems a bit of a wait-and-see scenario as we wait for more earnings to report. What do you think the take is or the sentiment is in the markets today?
Well, I don't think earnings will be enough this particular time. There's just so many things to balance from a fundamental and geopolitical perspective that we're in one of our longer wait-and-see positions that I think we could possibly be in as a firm. To me, when we've got essentially 5 things that can disrupt the markets in a big way, from geopolitics between the U.S. and Saudi Arabia, from rates, the yields, from the reaction that we're seeing in metals to what's going on in the S&P. Tariffs, is it going to get worse? Is it going to get better? Extended tariff arguments with perhaps the EU, which isn't settled yet. There's so much that can get in the way of this market going up that I don't think we're going to see accelerated selling. I just don't think you're going to see a lot of people putting money on the table in this kind of environment with all of these chips that could fall.
Bob, I'm quite curious, what's the word down there right now as it relates to the potential increased tensions between Saudi Arabia and the United States? Many people say that they don't want to increase tensions. You don't want to see any type of sanctions and retaliation because of the relationship that currently exists. What are you hearing?
It's such a hard thing, Catherine, because of what I do for a living and to a certain degree what you guys there at Bloomberg do for a living, where you're reporting on the economic effects of these things and the financial effects of these things. This one has affected traders and investors emotionally as well. I mean, again, the allegations against Saudi Arabia being currently denied by the king. You look at it from the one perspective of these kinds of things probably happen unreported all the time across the globe, and trade continues, deals continue, and equities continue to rise. This one is so public and so emotional that I don't think President Trump can escape the political pressure he may be under if it gets proven that Saudi Arabia had a lot to do with this. And then you got the issue with the crude oil prices. Seems like Saudi Arabia might have been involved in increasing crude oil production in anticipation of this kind of pressure. That's some of the talk I'm hearing amongst traders. So it's really a hard situation at this point. It's not someone you can wash away.
What do you think then in terms of when you take a look at the markets and maybe putting new money to work, or at least reallocating, because to your point, you're not necessarily seeing a lot of buying interest, and I think we're seeing that in the market, and we certainly saw it last week when there were definite sellers. You definitely also didn't see the buyers, and the corporate buybacks weren't there because of the blackout period. So you really had a bit of a vacuum as it relates to where are the buyers. So if people are going to buy, what sectors and or stocks do they want to buy right now, and or perhaps it's just a reallocation of assets? Where are they reallocating money to?
Well, currently they're going defensive as they can be, and we've seen with the backup of yields that they're going into treasuries. They're actually doing that flight to safety thing. We operate on a strict discount model. We calculate discounts out, and when the discounts are there, we pick the top level stocks to buy, and we buy them. We're going to have to buy at some point. We have a little bit of leeway to delay, but the sectors I believe are going to be some of the ones we couldn't buy prior. Some of the technology stocks and those things that have been hit that were leaders and were not at a discount, and maybe now they will be. Without doing the calculation, I can't get any more specific than that. But this personally for me is the time for the buy and hold, even if it's a medium term buy and hold, to get into some of those high flyers. They may back up quite a bit more, but you're getting a discount you may not see if they don't.
And Bob, let's talk a little bit about the banks, and we should bring up Bank of America, but also the few from last week as well. It seems as though the results just aren't going to be good enough. It seems as though investors are concerned that we are at peak cycles, that grinding out a good or an inline operating profit like we saw with Bank of America, Merrill Lynch today, it's just not enough. Let's bring up BAC if we can, and also some of the stocks from last week. What do you do with the banks? And don't we need to see leadership in the banks for the market to move higher?
No, I don't think we do anymore. I mean, financials have performed pretty poorly in the overall market rally because of the leadership in tech. But having said that, we actually like regional banks as a sector because I think that you're getting a slight steepening of the yield curve. Not quite enough, in my opinion, given where long-term rates went. This sort of bullish steepener wasn't quite steep enough. But that's where you're going to see the advantage of the steepening trade more so than the big money center banks that have so many other businesses now to contend with. Jamie Dimon did good again, as you mentioned. Bank of America did good again. Even Wells Fargo did good. But there's just too much of a headwind from the overall economic situation. If the yield curve can stay steep, the regional banks will do better than the money center.
When you talk about the overall economic situation, what does it feel like there right now? Retail sales this morning in the United States missed. There was a slight miss versus expectations. What's the feel from a consumer standpoint?
You're also seeing a trend down in consumer sentiment numbers over the last 2 or 3 months, which we hadn't seen in quite a while. You could even excuse the odd number, saying we were coming down from record highs, but the last University of Michigan sentiment, all the indicators missed expectations and were down. So I think it's safe to say that there's a little bit of a cautious feeling. That comes with full employment, with no move in the labor force participation rate. I think that's the issue. I think everyone is still fairly optimistic. It's not where it was 2 months ago, Catherine. I'll tell you that just anecdotally and in the data.
And just lastly here, when you talked about some of the tech companies and maybe looking for some opportunities when they are under a little bit of pressure, Apple, Goldman has a cautionary note surrounding Apple and specifically the China numbers. Are you looking at Apple on the buy side at all today?
Yeah, we are. Apple was one of our. So Apple's funny because it actually trades at a discount as the way we calculate it out more often than people think. So we got out of Apple. We captured about a 21% move in the equity itself. Not our gain. I'm just saying price to price, right? And we think we'll get Apple at the top of our discount list again. So I like Apple probably here. I'm saying probably because we haven't done a reallocation yet.
Understood. Bob, good to see you. Thank you.